Hey everyone, this is Shai with you. I wanted to take a few minutes over here to demystify a few thoughts and processes of the word called order flow, which is what we do every day over here at VTrend. Now, order flow, as you know, is basically demand and supply. Demand and supply seen on one chart, okay, is what is called order flow, right? Now, it is a simple candlestick blown open. There is no technical information over here about anything else, okay, beyond it being a candle or a bar or just about, okay, any other visualization tool you would look at. So what really happens is, in order flow, it is your candle, okay, which you have thrown open, and you are looking to see what is happening, okay, between the high and the low of that candle, the open and the close of that candle, and essentially, okay, what is moving within that candle, right? So if you take two candle bars, any two candles or any two bars of the same range, the same high and the same low, and you plot them on a chart, and they are the exact same thing, and let's just say, okay, they are 1 minute apart from each other, and you plot the open of one lower than the high, then by default, and our understanding is that the color of that candle would be green. And of the same high and the same low and the same range for the other candle, if you plot, okay, the open higher than the close, then the color of that candle would be red, right? So what really happens over here is the exact same range, okay, but the movement within that candle determines that color green and that color red. Now what we do in order flow is we strip this color out. All right, we remove that veil, we remove, okay, that color red, that color green, and allow you a look inside that bar, inside that candle, and to see exactly, okay, what is moving between that high and the low, and what is moving, okay, between the open and the close, and that is what is called order flow. So it is a market mechanism at work. It is a transparent look at what is actually happening at the exchange, the buying and the selling which is happening out over there, right? So don't think of it as an indicator, don't think of it, okay, as an add-on tool, don't think of it as anything else. It simply is not that. It is a candle stripped open, right? It's a candle, okay, whose color has been taken out. We do not, okay, remove that candle entirely. We just put it on the left side, but instead, okay, we focus on what is happening, okay, within that candle, within that bar, and that, my friends, okay, is what the order flow is all about. Now, since we are talking about order flow, I want to talk to you a little bit more, okay, about this term, okay, which we use in order flow called COT, commitment of trade. Now, if order flow is demand and supply, then COT is the net of that demand and supply. There is nothing else to it, right? Everything is working on demand and supply. And then if demand and supply are put together in a candle, okay, and if you net out that difference, okay, and that is the volume candle, if you net out that difference, the difference between the demand and the supply is what is called the COT of the bar, the commitment of trade within that bar. So if the demand is higher than supply in that particular bar, then that COT is green. And if the supply is higher than demand in that bar, then the COT is red, right? And a string of these COTs put together in 3 minutes, 5 minutes, 10-minute bars, you put them together, you immediately understand if that price is moving higher, is COT a participant to that move higher. And when price is moving higher but COT is, okay, not there, that means it's telling you that there is no new demand in this up move, okay, which we are seeing. And likewise, okay, if price is moving lower but COT is not showing you excess supply coming in, it is again telling you, okay, that there is no supply, okay, which is coming in into that price move. And this, if you follow as a process over a period of time, and we insist you, okay, you look at COT over a period of 10 bars, then that will tell you exactly, okay, what the market is doing at every single point in time, right? So order flow, simply demand and supply. COT is the net of demand and supply. I hope, okay, this clarifies, and I hope, okay, this is helpful. Thank you for listening in. All right. Good evening, everyone. Good evening. Good evening. I hope I'm able to come across to everyone. All right. So let's get talking today, guys. We are here after a very big event, right? The most important event of 5 years is almost past us. The market has navigated that entire volatility, and I do hope, for your all sakes, that you could, find yourselves excellent trading opportunities within that volatility. Monday, Tuesday, Wednesday, all three different sessions, different environments. The markets went up Monday, the markets went down half of Tuesday, up the other half of Tuesday, up Wednesday, and today, up and down, right? So typical market environment at work. Everyone, has got excellent trading opportunities. The writers made the most out of it. The buyers, could make out the most of it out of it. And we have to be thankful to the VIX, for providing us these trading opportunities and helping us to capitalize on the moves of the market. Right now, that the event is done, and the thing which the market was fearful or was overly expecting is out of the window. We have data on table, and it's not important actually what really happened. It's important to know what is the market doing regards to what the data is showing right now. So that event, whichever way you look at it, and there are no political colors in the markets ever, that's done, right? And we find ourselves today, 2 days after that event, that about 22,855, that's the Nifty on the spot, right? So majorly more or less where we were in the context of the auction last week. And the entire thing of the up move of Monday, which was that big up move based on the exit poll numbers, that has been negated. And after the event, we are not there. So that's what I mentioned early on Tuesday when I was looking at it. I told you there is a rejection of that entire profile, which happened on Monday. We came back, we reacted on Tuesday. There was an overreaction sort of to what really happened on Tuesday, and then to as a reaction to that overreaction, we reacted again on Wednesday, and today we're seeing a dual auction back in place. Right now, through all this, regular market participants would tell you that the market bakes in a certain expectation. The market bakes in a certain view of what can happen. Now, this is the market's way of looking at things, and it's the market's way of understanding what is in store for the rest of the week or for the coming sessions ahead. Right now, the market always builds up expectations, and what really happens around an event, those expectations, whether they come through or not, depends and flows the rest of the volume which comes into the market. Right now, specific to what happened on Tuesday, and I did mention the word overreaction over here, because if you just step back a bit and look at where we are trading today, 2 days after the event, we are exactly at the same place where we were all of last week. Right, so there was an overreaction on both sides, both up and down. Right, we went up to about 21,250, and I did say at that point of time that there was a bottom in place, and I was live tweeting it as it happened, and that's turned out to be a dependable bottom, and it's a secure low for us in market profile, which tells me that it may hold for the rest of the series also. Right, on the other hand, there is still that rejection up higher, which is that exit poll profile, which is still not been taken out 2 days after that major event. Right, so that rejection is still there, and we find ourselves navigating into the profile of last week. Right now, what we have over here on my chart is just to give you a brief look at what is expected up ahead. I have a monthly profile, 1 month profile. These are all 1 month profiles, Jan, Feb, March, April, May, and this is the month of June, and this is today's profile, which is up against this. Right, so this is what the auction has been doing from the month of November and December. November, As you know, okay, we've spoken about this many times. November, okay, was that big IPM, right? Towards the beginning of November, the Fed changed its tune. The biggest central bank in the world, it's changed its tunes, and it did say that in 2024 it is going to go in for rate cuts. The market, okay, saw that in the first week of November as evidence of no more hikes coming. We still got to see a cut in 2024, but the market, okay, is taken it, okay, that there are no more hikes coming in. And this was an event, okay, which triggered what we call in market profile line an IPM, an initial price move, which is a one directional move or a trending move upwards, and which we say is a start of a new trend, right? So that is what has happened since November, December, Jan, Feb, March, April, and May. We are seeing a profile which has moved in from those lows of November and straight up to about 23,000. And for the first time in May, we got, okay, a profile, okay, which is this. Now the gray shaded region is your value area. All this gray shaded region, this is your value area. So this is the value area for the entire month. Now value area, for those, okay, who are new to the market profile, is the region where the market has traded 70% or 68%. To generalize it, it's 70%, but it's about 68.4% of the entire volume of that month, right? And we found a way, okay, of putting that current futures volume on the spot chart. These are spot prices. So the volume over here is of that current month future, and we've gotten the value area of that month. And what we can see in the month of May, there is an overlap of value. Now this is a technical term, but what we say is that an uptrending profile, an uptrending move of the market will always be met with higher value areas. That means one value area like December was higher than November, January was higher than January was higher than December, then February is higher than January, and March value area high is higher than February, and April value area high is higher than March. So that's an uptrending profile, right? The value area has to keep going upwards. But in the month of May, we got a sideways going value area wherein, okay, the value area highs, okay, did not really cross. Now this is still forming in the month of June, and this value area, okay, will take shape, and we'll look at this at the end of this month, at the end of the month of June. But what is it now telling you is that the market is now gone from a trend up, or what we call an imbalance in market profile, to a balance, which is that big letter B. So there is a saying in market profile, and this works across time frames. This works across your 5-minute time frame. This works across your 30-minute time frame. This works across your 1 week, 1 month, even a 1 year time frame. And that saying is simply this: the market always moves from an imbalance to a balance, right? So within the context of this entire move stretching into the middle of 2024, our current calendar year, we are seeing a balance formation, right? And if I have to give you a bigger picture of what has actually happened in the past few months, what I'll do is I'll merge, okay, these 4 profiles. So from that month of February right up over here, and if you have these charts open, a simple way of doing it is picking up the profile on the left and picking up a profile on the right, doing a control shift and pressing this merge button right here. You will get a combined profile. Right now, this is the most important profile for us as we go into the latter half of this year. Right, this is a 4-month merged profile right here, and it resembles, okay, what this market actually represents, what this market has done over the past 4 months. Now this is going to be important as that big event is out of the way, and we are going to be wanting to see how this market stays above this value area high, right? So a few things happened in that move of Tuesday, we actually were above this value area. We were actually above this value area, but we came down through this value area on Tuesday, right here. And we went up, okay, right down to this value area low. And some of you, okay, would know that is called the value area rule or the 80% rule. And I've been saying this again and again, that this value area rule works in all time frames, right? It works in all situations. It works in all markets. So this is, okay, what happened early on Tuesday, which created that volatility. But that's not just the entire part of it. What it also did was it came back from this value area low and went up to the value area high, and currently it's trading above the value area high. Right now, if you need to look at a swing view, and I'll say that again, we basically, okay, talk a lot about intraday and the next 2 or 3 days out over here and at WeTrender, because that's where the challenge is. Forming a long-term view, guys, okay, it's a very, very simple thing to do. Okay, I should not be using that word simple for anything related to markets. I know it, but between choosing a trend on an intraday and between choosing a trend on a longer time frame, anybody who's been in the market will tell you that picking long-term trends is not a challenge at all. Anybody can do it. Okay, there is no complexity at all. The trend over a long period of time is up. I was speaking, okay, to one of my friends, and I was asking him what he was actually asking me, okay, about this event and these elections, and he was very worried, okay, about his portfolio and what was actually going to happen, okay, because of that event. And I asked him, okay, what is the time frame of your hold? Okay, do you require this money in the next 2 years? Do you require this money in the next 5 years? And how long are you invested for? And he came back and he told me, okay, no, I don't require this money, okay, for the next 10-15 years. I'm not worried. I can, okay, manage, okay, with this for the next 15-20 years. And I told him that regardless of what happens on June 4, this was a conversation from last week, okay, earlier, okay, than June 4. I told him, regardless of what happens on June 4, the market is going to be up by 2035. Okay, regardless of what the highs are of 2024, the market is going to find itself making new highs in 2035, 2040, right? So this is the structure of the market. And if you look at where we are today and where we were 20 years back, you will find, okay, that we are definitely up. So there isn't a lot of challenge when it comes, okay, to understanding long-term trends. That is up. The challenge is always, okay, about navigating, okay, the short-term moves. Because if you ask me what's going to happen on 6 months from now, my answer to you would be, I don't know. What can happen 6 years from now? I will tell you, okay, it's higher, okay, than where it is right now. What can happen 6 days from now? I don't know. What can happen tomorrow? I don't know. All right. For that, okay, we have to rely on data. For that, okay, we have to rely on information which the market is giving. And that's where, okay, the challenge of the market comes in. And that's where the biases, etc., are made. Right. But we are not going to go, okay, that much ahead, and we're not going to be discussing, okay, short-term moves over here. What we are basically interested to know is how the market is positioned going forward now that the event is done. And I'd like to simply, okay, give you one point over here based on my understanding of markets. This value area high zone, right? This is somewhere around 22,550. And if you can mark this on your charts, you can say that this market is biased upwards as long as we stay above this value area high. Okay, let me break it down further for you. And this is a weekly profile. This is that weekly profile. So this is, okay, where the market, okay, put in that max volume last month. This is again a monthly profile. I'll come back to April and May. And these were two composite profiles where the POC, okay, was somewhere around this 22,450 zone. Okay, if this market stays above this zone for the rest of the series of May and into June, July, August, you can see, okay, that this market is biased upwards. Having said that, it's still got a job to do up high over here, because the market has put in a responsive selling pattern right here, right, where you see this pink over here. this market okay needs to take out that, and somewhere around here is also our failed auction, that 23,150 zone, okay, which I've been speaking to you about, right? So it's biased upwards. The momentum is not there till we okay completely take out this failed auction zone. And once okay this 23,150 failed auction 23,200 zone is taken out, then okay you can expect fresh new demand to come into the market, right? So that's the story over here for the Nifty. If you have okay, any questions okay to ask okay about trends, etc., you can shoot up over here. Most of you okay would be looking at it in terms of targets, etc., about where it is. I feel okay that if this move gets legs okay above 23,000, then about 24,500 is what we can expect okay by this year end, November, December, Jan. And then okay we look at okay a fresh biasing and a fresh positioning for 2025 in the early part of January, February. We'll make a fresh view for the next 6 months out. Okay, this is gonna be the picture which is gonna play out. Right. Any questions okay over here? Okay, so far okay related okay to market profile. I'll come to the order flow questions also. I know a lot of you have questions okay about what really has happened over the past few days. But if you have any questions okay about our understanding about where we are headed over the next 6 months, okay, please feel free to ask. So this on screen is a weekly profile. This is where we are. And this is okay how it worked out the other day. Okay, I spoke okay about that rejection happening over here of this particular profile, which was that the exit pole profile. These are the singles okay which the market okay is wanting to test okay from the open today. It did not okay get a lot of demand early at the open, the first half of the day, but later on okay it did not okay break this 22,720 zone, and some demand has come back. So it's challenging okay these A period singles and expecting okay to take them out. If the market finds an entry in this A singles, it should okay make a run okay for this VPOC at 23,229 over a period of next few days. So that's the upper side. We have to just wait and see tomorrow if it wants to sustain into these A period singles. Okay, so the question is okay how to find responsive selling in market profile charts. You actually okay would get a better idea of responsive selling in order flow charts. If I explain to you about finding it in market profile charts, it's going to make it a little bit complex. But the best way okay to find the responsive selling pattern is to have an order flow chart open. And in the order flow chart in the training library and the e-course, we have described to you okay how to find the responsive selling pattern. Okay, so the question is if the 23,150 is not taken out, is the top made for the rest of the year? That's a complex question. I'm not at all saying okay that the top is made at all. Okay, so what we are doing is we are finding ourselves okay in a position okay where the market okay has rejected a higher profile, but it's not met supply lower. Okay, at the same time, as I just explained to you, we are above the value area high of the last few months. Okay, that composite profile which I showed you, right? So the market is with buyers currently, but because of that rejection okay which happened earlier in the week on Monday, the job of buyers is cut out, right? If you understand the market profile, and I'm sure okay a lot of you do, when Jim Dalton okay talks about the market profile, he only basically speaks about two things: what is the market doing, and is it doing a good job doing what it is doing right now, right? So with that as a context, if you ask yourself what is the market doing, it is staying above value area high. Is it doing a good job? That you will know when it takes out okay that failed auction point. Till it takes out that failed auction point, the market is not doing a good job, because the buyers have to take a failed auction point which has been established by sellers. If the question is, okay, if the market is above weekly value area high and below value area high, then what should be the view? So in that case, okay, the market is sideways, right? So the condition over here is if the market, okay, really, okay, wants to go up, and you can see, okay, that there is a trend up in the market, then in that trend up, the market is gonna create higher value, right? So if a market is trending up, the value area high will keep trending up, trending up, trending up, till the market, okay, goes sideways and the value area goes sideways. Right. Any other questions, okay, based on the market profile? So the context, okay, for IPM is a strong move away from a balance. So you'll have to refer the books, okay, by Pete Stadelmeyer on markets. He's basically, okay, described an IPM. IPM stands for initial price move, which is basically a move to imbalance. That means, okay, it has to come from a previous or an existing balance. So in the context of what I spoke to you about, the market was balancing before November, right? Prior to that big Fed meeting, this is, okay, what the market was doing. This was something similar to what is happening right now, right? So this was from July, August, September, October. This just came in, okay, around here, right? And this is actually, okay, when it started moving up. So this is what we call the IPM, the initial price movement. And we'll see this, okay, many times, okay, the market, okay, goes, okay, from imbalance to a balance, and it forms, okay, an imbalance again. So that is what Stadelmeyer says when he says that a new IPM has begun. It's a move to a new area and a market, okay, searching for higher value, right? Now all this move of early in the June was just 80% rule playing out again and again. So this was that value area. So that's why, okay, we got all that excess volatility, and not entirely unexpected. We crossed, okay, from this value area high to this value area low, and then again, okay, yesterday we went back from value area low to value area high, which is why, okay, we were extremely bullish and looking for buy side trade. So once, okay, the market dropped, and it dropped down, okay, to this low, and I pointed out that low to you, 21,250, okay, was where, okay, you should have covered. But the minute, okay, it came back above this value area low, you had no business, okay, to be short into the market again. In fact, in order flow charts, we saw a lot of short covering happening at those levels. So the question is there a possibility to retest June 4? The possibility is always there. Always remember, whatever level, okay, you are in the markets, never underestimate the market. The probability and possibility of things happening are always there. But what is the data telling you? The data is now telling you that this in market profile is a secure low. That means it's got a tail, right? And this is also a tail, which is why I'm saying, okay, this still needs to be taken out, okay, for the market, okay, to progress higher. But this is called a secure low. That means, okay, there is a tail over here, and a secure low generally gives you about, I won't say 100%, but it gives you a 90-95% probability that this may hold. So I was answering this question earlier also, and that makes me believe, okay, that this low of June, okay, is going to hold, because in market profile it's called a secure low. So the question is, okay, if it breaks the value area high, okay, will it happen again? Of course, okay, that 80% rule, okay, can happen. If we break, okay, through this value area high again, I'll go, okay, with that around 22,550. We may go, okay, down to that low of that value area low again. It's happened 2 times. It does not mean, okay, it can happen only 2 times. It can happen, okay, any number of times also. The same concept of 80% rule works in all time frames. Follow the process, guys. The process is extremely important over here. Right, now there are some questions, okay, coming on order flow. I'd like to, okay, address, okay, a few of them. Let's look at, okay, what actually, okay, happened YA order flow. And when we're looking at order flow, guys, I always say, so this is the order flow chart of today. I'll just blow up the PPR. This is okay what happened. So early on, there was a lot of reds, okay, which came in, and this is what we call a responsive selling pattern. An initiative seller came, and we had to make new lows because of that. But down over there, there was a lot of buying which came in, and the COT, okay, was plus right through, okay, from about 12:30, 12:45 in the afternoon. So this is again an RB and IB. So you can say, okay, that this was a dual auction. The market, okay, went up, found sellers, went down, found buyers, and it returned, okay, back, okay, into a state of equilibrium. And you can say a normal day, okay, was established in the markets, where the market, okay, stayed within a range, and there was a dual auction at play. Now, to address, okay, a few questions on the order flow, I just like to, okay, say a few things over here, right? Now, I believe in an equation where x plus y, so x is one factor, y is another factor, and x plus y is equal to z. That is, okay, what I say. Right. So x is to us market profile, and y is order flow. Now, x in market profile does not just mean one thing. Okay, so x, okay, could be a number of things, okay, come in the market profile, like I just pointed out to you: value area high, value area low, POCs, opens, failed auctions, C types, trend days, normal variation days, neutral days, the spike at the close, the K period, the G period. All of these put together constitute the market profile. Okay, can I say only a C period is market profile? Or can I say only the failed auction is market profile? Or can I say only the open types is market profile? Absolutely not, right? A sum of all these things and these elements put together give us, okay, something called the market profile. So that is the X part of it. The Y part of it is order flow, right? And just like, okay, a sum of many things, okay, make up the market profile, I always tell you, okay, that in order flow, a sum of many things, okay, make up the order flow. As traders, we try to look for simple things, and we try to, okay, simplify things, okay, much to our own pain, right? The markets were never meant to be simple. The markets are one hell of a complex beast. They are so complex that even the best brains in the world, okay, will not be able to figure them out. But we as humans, okay, tend to look out for the simple things and simplify things, which is not the correct way of looking at things. We underestimate the market, right? So back to what I'm saying about order flow. Order flow is also a sum of many things. Just like the market profile is a sum of many things, the order flow is a sum of your COT, your IBIS, RBRS, okay, your single prints, your volume clusters, your liquidity, illiquidity zones. At least, okay, 5 of them, okay, when they come together, 5 different elements, they form an order flow chart. What people do is they focus, okay, only on one aspect of the order flow, and then they say, okay, that this is order flow. This is the furthest, okay, you can be away from the truth, right? It's not the correct way of understanding markets, and it's definitely not the correct way of understanding order flow, right? So for us, when we're looking at an order flow chart, we are looking at where the responsive buyers are. We're looking at initiative buyers. We're looking at the commitment of trade, the COT. We're looking at volume clusters. We're looking at zones of liquidity, where the market is liquid, where the market is not liquid. And all of that, okay, when they come together, okay, they put in a perfect picture for us, right? Now, for instance, today, when we were trading, the market was going up, but have a look at this COT in the very first half of the day. This is insignificant. This tells me, right, okay, for the day today, 475, 1278, 5423, 834, 735, and this market is going up and is meeting responsive selling patterns, RS, right over here. But it is going up, okay, on red COT, right? It can go up, but I don't want to be a party to a trade where the market is going up on red caught, okay, that move will never last. That move will never last, okay, because a market, okay, which does not move up on new demand is not gonna move up at all, right? It's gonna always, okay, retrace, it's gonna come back, and it's gonna give you an opportunity to come back into a market. So in my order flow, whenever I'm reading order flow, and if I see a situation like this and the market is going up, I'm not a participant in the longs because of this, because the elements are not coming together. And if you see all those people who were trading with me in the VMR, and I told them also, don't be long in the market today, okay? In the morning itself, everybody was saying, why are we not going long? Why are we going not in the long? But I've seen many times, okay, this situation before. I knew, okay, that this was going to pull back, and we never had a long. Now, just because the market is not long does not mean it is a short. For a market to go down, it needs an initiative selling candle, right? Now, what is an initiative selling candle? An initiative selling candle is a bunch of market orders coming together which force price to move. That's why, okay, it's called an initiative selling. That's the sellers are coming together and initiating activity, and that initiative activity is what forces the market to move in a certain direction, right? So if we have this kind of an initiative selling candle, in this case, okay, the market, okay, moves lower, 22,890 to 22,760, much more faster, okay, than all this. The entire up move, okay, from 22,740 right up to about 22,970 took about 2 hours, but in 1 hour, okay, we got into those lows. Why? Because it was initiative in nature, right? But right here, okay, where it went lower, the initiative selling, the market, okay, found some closure happening, some demand, okay, coming in, that you can see in these green numbers. And then again, okay, it came lower, it found, okay, more demand, okay, and then, okay, then initiative buyers, okay, stepped up, and all through a condition was created, an environment was created via the court for this market, okay, to go up, right? And at the end of the day, this is an end of the day reading, the 10 bar court, okay, was 29,000 plus, which tells you, okay, that the environment is now good for it, okay, to go higher, right? Now contrast this, okay, to what happened earlier in the week, right? So I'd like to just give you some context, okay, about what the positioning was prior to the exit poll, right? Now this is the 31st of May, and the exit polls, okay, were coming in on Saturday post 6 p.m. But this was the Friday close. The market, okay, was expecting, okay, a few things, and caught, okay, was built up on the long side, right? So you can see, okay, that the net caught over here over the closing of Friday was built, and there was demand, okay, coming in. So I was not at all surprised that the gap up came on Monday morning, because it the environment, okay, was there for the gap up to come. And even on that gap up, in that very first 30 minutes, there was a lot of buying which came in, and the caught, okay, continued staying up. 36,000 is a good caught, and this market, okay, was, okay, having a lot of profit booking, etc. These are minor numbers, but the big numbers, okay, was there right at the open, and it took the market, okay, up higher to about this level of 22,440. This was on close. Now this was a market, okay, which went long into an event. Okay, I'll repeat that again. The market, okay, was positioned long into the event. Now, at the close, some booking happened, but majorly through Friday and Monday, the market, okay, was positioned long into the event. Now, at the open on Tuesday, when the election news, okay, was coming in, this long, okay, quickly booked. You can see this over here, 2166, 193231. There was somebody, okay, who was trying to buy up over here. Maybe, okay, I don't know, okay, why he was trying to buy, but we were definitely below the failed auction point. But there was all this long coming off, and they started adding aggressive sells from here, initiative sellings over here. And this, okay, we saw, and this caught was minus 70,000 at the end of the A period. Now, this was the condition which created that 1,800 point move lower. Right at the open, 23,140, you're not seeing any kind of demand coming in. Absolutely, okay, no greens, okay, coming here. And whatever greens, okay, were coming in were far and quickly getting outpowered and outnumbered by sellers. We finished with minus 70,000 in that first 30 minutes, right? And initiative selling candle came in at 10:45. This IS candle again dominated by sellers, and this caught is again huge, minus 31,000. Anytime that caught becomes 40,000 in a 30-minute bar, you have to pay attention. And that's created that big impulse move. And a third IS bar came at 11:45 from 22,274, and the market dropped down a further 1,000 points, 21,170. And if you can see all this caught over here, this was all red, telling you that the sellers were completely dominating this. Now of course you come to know this through the movement of price, but the magnitude of what is expected and the kind of move which is expected will always come because of these caught numbers. This 70,000, you will not see it very often, and when you see it, you know immediately now this market has got a lot more supply than it ever has, right? So that was that pricing over there then. Now this is today. So that 10 bar caught is now positioned green. So all that red, that 70,000. In fact, at one point on Tuesday when the market was moving down, the 10 bar caught was at minus 170,000. And that is why we dropped 1,800 points in the day, because the supply was overpowering demand by that level. Now this IB bar is come, there are responsive buyers, and we know for a fact that the 10 bar caught is green. So now we are looking for more upsides. So what am I saying over here? Very simple. X, the market profile, which gives you structure, and that entire market profile chart which will tell you what the market has been doing this past couple of months. The Y component is your execution. It's where you are going to be executing and how you're going to be executing, and you're going to be executing along with initiative activity on a caught which is green for buyers or red for sellers, right? So I see an IS candle and I do not see a 10 bar caught red, I am not going to sell, right? But when I see an IB bar and a 10 bar caught in green, I'm going to buy. And the same thing I'm going to do when it is a 3-minute chart. If I see an IB bar like this is an IB plus IB pattern coming out, right? But look down, the caught is green in a 3-minute bar, and this tells you that this market now wants to go up. So the same IB plus IB, the caught is green, the 3 bar caught and everything of the past 10 bars is also green. Now you are creating a situation for you to buy into the market, right? So know the market profile, absorb what the market is trying to tell you via the market profile. The Y component is your execution, the order flow, and order flow is nothing but the demand and supply coming out to you live. And when you can see that demand and supply coming out to you, you're throwing away all your chances of making mistakes, and you're getting yourself positioned with the big players of the market. So that's the question is, is anything mandatory? There's nothing mandatory. You don't need even charts. Charts are also not mandatory to trade. It's completely on your understanding about markets and how active a trader you are. What I'm speaking to you about is the way professionals would trade the market. Now of course if you are a part-time trader and you trade off a mobile, etc., all this does not make sense to you. You're just looking for those quick trades here and there. You won't require all of this. But if you are that serious active trader who wants to trade the markets professionally, who wants to get most of your trades right, then this is something which you need to consider a lot more. Right, any questions guys so far? So the question is on what quantity is considered as an LLT. When there's no quantity as such. LLT is based on execution, and whenever an large LLT or a large lot trader shows up, it will show up either as a green dot or a red dot in your charts. It could be any quantity. A large lot trader would show up. There is a program which helps us calculate it. It's not only relevant to the quantity of the trade. Right. So I hope I've been able to convey my thoughts to you about where we are. I spoke to you about the market profile and how we are going to be looking at it from a market profile perspective going forward. I spoke to you about the various elements of the market profile, and remember what I mentioned, a number of elements coming together form the X. I spoke to you about the order flow and about how you need to execute better based on the information of the order flow, which is your Y component, and work both with X and Y, so that your objective becomes clear, right? So with this, I'd like to call this session to a close if there are no more questions. Thank you all for coming in, for listening to this. There will be a recording of this available on YouTube. You can go through it. You can also check the recording on my Twitter handle. It's going to be there, and you can review it any point in time. If you have any questions, please feel free to ask also. Right. Thank you all for coming in, guys.